Marcus had $100,000, 42 years old, software engineer in Austin, Texas, 10 years of disciplined saving, $100,000 sitting in a savings account earning almost nothing. Marcus had one question: which ETF do I put this in? He asked his financial advisor, got a vague answer. He searched YouTube, got 10 different opinions. He asked his colleagues at work, got 5 more conflicting recommendations. So Marcus did something different. He ran the numbers himself. He took his $100,000 and tested 5 completely different ETFs over the same 10-year period, tracking exactly what happened to his money year by year. What Marcus found changed everything about how he thought about investing, because the difference between the best and worst ETF choice was not 10%, not 20%, not even 50%. Over 10 years, the difference between the highest performing ETF and the lowest was $289,000. Same $100,000, same 10 years, $289,000 difference in outcome. Today, you are going to see exactly what Marcus found. 5 ETFs, 10 years of projections, real numbers year by year, and at the end, 2 complete portfolios built from all 5. Let us get into it. This channel covers the investment strategies, data, and decisions that actually move the needle on your financial future. No hype, no speculation, just the numbers and what they actually mean for your money. Subscribe so you never miss a video. Now let us follow Marcus through all 5 ETFs and find out which one actually won. Before the numbers, let us understand exactly what we are measuring and why it matters. Every ETF in this comparison is evaluated on 3 things. First, portfolio growth. How much does the $100,000 actually grow in value over 10 years? Second, dividend income. How much cash does the ETF pay out each year? Third, the trade-off. What does each ETF give up to deliver what it promises? Because here's the truth about ETF investing that most people never fully understand. Every ETF makes a choice. It can prioritize growth, or it can prioritize income, or it can try to balance both, but it cannot do all 3 perfectly simultaneously. Understanding that trade-off is the difference between an ETF that serves your goals and one that quietly disappoints you for years before you figure out why. Here are Marcus's 5 ETFs. ETF 1, VOO, the S&P 500 anchor. ETF 2, QQQ, the Nasdaq growth engine. ETF 3, SCHD, the dividend grower. ETF 4, JEPI, the income generator. ETF 5, QQQM, the growth and income hybrid. And at the end, 2 complete portfolios built from all 5. ETF 1, VOO, the S&P 500 anchor. Marcus starts with VOO, the Vanguard S&P 500 ETF. VOO tracks the S&P 500, which means it owns a proportional piece of approximately 500 of the largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Nvidia, Alphabet. When these companies move, VOO moves with them. There's no clever strategy here, no fund manager making calls, no sector bets or timing decisions. VOO is built to mirror the performance of the U.S. economy at the lowest possible cost. Expense ratio, 0.03%. For every $10,000 invested, Marcus pays $3 per year in fees. Everything else stays invested and compounding. Key metrics. Dividend yield, 1.15%. Modest. Income is not the main feature here. Dividend growth rate, approximately 6% annually. Steady but modest in absolute dollar terms. Share price appreciation, approximately 13.3% annually. This is where VOO does its real work. Here's what $100,000 looks like in VOO over 10 years. Year 1. Portfolio grows to $114,420. Dividend income, $1,110, or approximately $93 per month. Year 2. Portfolio grows to $130,919. Dividend income, $1,177, or approximately $98 per month. Year 3. Portfolio grows to $149,711. Dividend income $1,248, or approximately $104 per month. Year 4. Portfolio grows to $171,270. Dividend income $1,322, or approximately $110 per month. Year 5. Portfolio reaches $195,892. Dividend income $1,402, or approximately $117 per month. Year 6. Portfolio grows to $224,146. Dividend income $1,486, or approximately $124 per month. Year 7. Portfolio grows to $256,381. Dividend income $1,575, or approximately $131 per month. Year 8. Portfolio grows to $393,271. Dividend income $1,669, or approximately $139 per month. Year 9. Portfolio grows to $335,490. Dividend income $1,770, or approximately $148 per month. Year 10. Portfolio reaches $383,837. Dividend income $1,886, or approximately $156 per month. After 10 years, Marcus's $100,000 has grown to $383,827, nearly 4 times his original investment. Without picking a single stock, without timing the market, without doing anything except holding VOO. But the income tells a completely different story. $156 a month after 10 years is not enough for most investors to feel their money is meaningfully working for them. This is exactly how a growth-first ETF works. The return stays locked inside the account, growing the portfolio value rather than showing up as spendable cash. If Marcus's goal is long-term wealth accumulation and he doesn't need income from this money right now, VOO is one of the most reliable vehicles available. But if income is any part of what Marcus needs, VOO will frustrate him. ETF 2. QQQ, the Nasdaq Growth Engine. The second ETF Marcus tested is QQQ, the Invesco QQQ Trust. QQQ tracks the Nasdaq 100 index, which means it owns the 100 largest non-financial companies trading on the Nasdaq exchange. Unlike VOO, which spreads across all industries, QQQ is heavily concentrated in technology. Apple, Microsoft, Nvidia, Meta, Amazon, Alphabet. These names dominate the fund. Technology makes up approximately 60% of QQQ. Consumer discretionary and communication services make up most of the remainder. This concentration is QQQ's greatest strength and its most significant risk. When technology leads the market, QQQ leads everything. When technology struggles, QQQ feels it deeply. Expense ratio, 0.20%. Higher than VOO, but still reasonable for a fund that has consistently delivered extraordinary long-term returns. Key metrics. Dividend yield, 0.58%, even lower than VOO. Income is essentially irrelevant here. Dividend growth rate, approximately 6.3% annually from a very small base, barely noticeable. Share price appreciation, approximately 18.2% annually. This is where QQQ does its real work. Here's what $100,000 looks like in QQQ over 10 years. Year 1. Portfolio grows to $118,780. Dividend income, $580, or approximately $48 per month. Year 2. Portfolio grows to $141,088. Dividend income, $616, or approximately $51 per month. Year 3. Portfolio grows to $167,593. Dividend income, $655, or approximately $55 per month. Year 4. Portfolio grows to $199,118. Dividend income, $696, or approximately $58 per month. Year 5. Portfolio reaches $236,542. Dividend income, $740, or approximately $62 per month. Year 6. portfolio grows to $280,971. Dividend income $786, or approximately $66 per month. Year 7, portfolio grows to $333,794. Dividend income $836, or approximately $70 per month. Year 8, portfolio grows to $396,445. Dividend income $888, or approximately $84 per month. Year 9, portfolio grows to $470,785. Dividend income $944, or approximately $89 per month. Year 10, portfolio reaches $559,112. Dividend income $1,003, or approximately $84 per month. After 10 years, Marcus's $100,000 has grown to $559,112, more than 5.5 times his original investment. This is dramatically stronger growth than VOO's $383,827, a difference of $175,285 from the same starting amount. But the income is even lower than VOO, only $84 per month after 10 years. QQQ makes one thing crystal clear. If Marcus's priority is maximum portfolio growth, and he has a long time horizon, and he can tolerate significant short-term volatility, QQQ delivers results that are genuinely difficult to match. But income investors will find QQQ completely unsatisfying. The dividend barely exists. It never becomes meaningful, regardless of how long Marcus holds. ETF 3. SCHD, the dividend grower. The third ETF Marcus tested is SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is where growth and income start working together instead of trading against each other. SCHD tracks an index that screens specifically for quality and dividend consistency. Companies must have a history of paying dividends consistently, financial strength to sustain those payments, and a proven pattern of growing the dividend over time. The result is approximately 100 carefully selected companies that have earned their place through financial discipline. Expense ratio, 0.06%. Remarkably low for a fund that actively screens for quality. Key metrics. Dividend yield, 3.51%, meaningfully higher than both VOO and QQQ. Dividend growth rate, approximately 10.6% annually. This is where SCHD genuinely stands apart. The dividend grows faster than almost any comparable ETF. Share price appreciation, approximately 9% annually. Not as fast as QQQ, but strong enough to matter significantly over a 10-year period. Here is what $100,000 looks like in SCHD over 10 years. Year 1, portfolio grows to $112,550. Dividend income, $3,510, or approximately $293 per month. Year 2, portfolio grows to $126,676. Dividend income, $3,882, or approximately $324 per month. Year 3, portfolio grows to $142,550. Dividend income, $4,294, or approximately $358 per month. Year 4, portfolio grows to $160,406. Dividend income, $4,749, or approximately $396 per month. Year 5, portfolio reaches $180,537. Dividend income, $5,252, or approximately $438 per month. Year 6, portfolio grows to $203,205. Dividend income, $5,809, or approximately $484 per month. Year 7, Portfolio grows to $228,706. Dividend income, $6,424, or approximately $535 per month. Year 8. Portfolio grows to $257,394. Dividend income, $7,105, or approximately $592 per month. Year 9. Portfolio grows to $289,683. Dividend income, $7,861, or approximately $665 per month. Year 10. Portfolio reaches $326,050. Dividend income, $8,697, or approximately $725 per month. After 10 years, Marcus's $100,000 has grown to $326,050. Solid growth. Not as spectacular as QQQ, but significantly stronger than JEPI. But look at what happened to the income. By year 10, SCHD is paying $725 per month. That is nearly 9 times more monthly income than QQQ, and more than 4 times more than VOO. This is the SCHD compounding dividend effect that most investors completely underestimate. The dividend grows at 10.6% annually. Over 10 years, that means the monthly income almost triples, from $293 in year 1 to $725 in year 10. For Marcus, the story SCHD tells is this: you will not get QQQ's growth, but you will get meaningful income that grows substantially every single year. And your portfolio will still be worth more than 3 times what you started with. That balance is exactly what SCHD is designed to deliver. ETF 4. JPEI, the income generator. The fourth ETF Marcus tested is JPEI, the JP Morgan Equity Premium Income ETF. JPEI is built completely differently from every other ETF in this comparison. It does not just hold stocks and wait for dividends. It holds large U.S. stocks and simultaneously sells covered call options on those holdings to generate substantial additional income every single month. Here is how covered calls work in simple terms. JPEI owns a large portfolio of stocks. It then sells agreements giving other investors the right to buy those stocks at a set price in the future. Those investors pay JPEI upfront for that agreement. JPEI keeps that payment regardless of what happens next. This strategy generates substantially more income than traditional dividend ETFs. But the trade-off is clear. When stock prices rise sharply, JPEI may have to sell holdings at the agreed lower price rather than benefiting fully from the gain. This limits upside portfolio growth significantly. Expense ratio, 0.35%. Higher than the other ETFs, but justified by the active management this strategy requires. Key metrics. Dividend yield, 8.06%, meaningfully higher than both VOO and QQQ. Dividend growth rate, approximately 7.9% annually. This is where JPEI genuinely stands apart. The dividend grows faster than almost any comparable ETF. Share price appreciation, approximately 2.64% annually. Not as fast as QQQ, but strong enough to matter significantly over a 10-year period. Here is what $100,000 looks like in JPEI over 10 years. Year 1. Portfolio grows to $110,698. Dividend income, $8,069, or approximately $672 per month. Year 2. Portfolio grows to $126,641. Dividend income, $9,398, or approximately $783 per month. Year 3. Portfolio grows to $135,651. Dividend income, $10,754, or approximately $396 per month. Year 4. Portfolio grows to $150,167. Dividend income $12,290, or approximately $1,024 per month. Year 5. Portfolio reaches $166,235. Dividend income $14,150, or approximately $1,171 per month. Year 6. Portfolio grows to
$184,013.
dividend income $16,063, or approximately $1,339 per month. Year 7. Portfolio grows to $203,670. Dividend income $18,368, or approximately $1,531 per month. Year 8. Portfolio grows to $225,388. Dividend income $21,003, or approximately $1,750 per month. Year 9. Portfolio grows to $249,367. Dividend income $24,011, or approximately $2,001 per month. Year 10. Portfolio reaches $275,822. Dividend income $27,452, or approximately $2,288 per month. After 10 years, JEPI is generating $27,452 annually, $2,288 every single month, from a $100,000 starting investment. No other ETF in this comparison comes close to that income level, but the portfolio itself only reaches $275,822 after 10 years. Compare that to QQQ at $559,112. That is a $283,290 difference in portfolio value. This is the JEPI trade-off in completely clear numbers. You get dramatically more income. You give up significant portfolio growth. For Marcus or any investor who needs substantial monthly cash flow right now, perhaps approaching retirement or already there, JEPI transforms what $100,000 can do monthly in a way no other ETF can match. For investors with 20 or 30 years until retirement who want maximum portfolio growth, JEPI is simply the wrong tool for that job. ETF 5, QQQM, the Growth and Income Hybrid. The fifth ETF Marcus tested is QQQM, the Invesco NASDAQ 100 ETF. QQQM tracks the exact same NASDAQ 100 index as QQQ, but was designed specifically for individual retail investors who want to buy and hold rather than trade actively. The key difference from QQQ is the expense ratio. QQQ charges 0.20%. QQQM charges 0.15%. That 0.05% difference sounds tiny, but on $100,000 over 10 years, the compounding effect of lower fees adds hundreds of dollars to the final outcome. QQQM also tends to pay a slightly higher dividend yield than QQQ, making it a marginally better balance between growth and income for long-term holders. Key metrics: dividend yield, 0.78%, still modest but noticeably higher than QQQ's 0.58%. Dividend growth rate, approximately 8.1% annually, faster dividend growth than QQQ. Share price appreciation, approximately 17.9% annually, marginally lower than QQQ, but still extraordinary over a 10-year period. Here is what $100,000 looks like in QQQM over 10 years. Year 1, portfolio grows to $117,920. Dividend income $780, or approximately $65 per month. Year 2, portfolio grows to $139,050. Dividend income $843, or approximately $70 per month. Year 3, portfolio grows to $164,060. Dividend income $911 or approximately $76 per month. Year 4. Portfolio grows to $193,560. Dividend income $985 or approximately $82 per month. Year 5. Portfolio reaches $228,330. Dividend income $1,064 or approximately $89 per month. Year 6. Portfolio grows to $269,390. Dividend income $1,150 or approximately $96 per month. Year 7. Portfolio grows to $317,820. Dividend income $1,242 or approximately $104 per month. Year 8. Portfolio grows to $374,990. Dividend income $1,343 or approximately $112 per month. Year 9. Portfolio grows to $442,540. Dividend income $1,451 or approximately $121 per month. Year 10. Portfolio reaches $522,110. Dividend income $1,568 or approximately $131 per month. After 10 years, QQQM reaches $522,110, slightly less than QQQ's $559,112 because of the marginally lower growth rate. But the income is slightly better at $131 per month versus QQQ's $84 per month. For long-term retail investors who want the NASDAQ 100 exposure of QQQ but prefer to hold a fund optimized for accumulation rather than institutional trading, QQQM is the better vehicle. Lower fees, better income, nearly identical growth trajectory. The comparison, all 5 side by side. Before the combined portfolios, here is every ETF after 10 years, starting with $100,000. VOO, portfolio $383,827. Monthly income $156. QQQ, portfolio $559,112. Monthly income $84. SCHD, portfolio $326,050. Monthly income $725. JEPI, portfolio $275,822. Monthly income $2,288. QQQM, portfolio $522,110. Monthly income $131. The pattern is unmistakable and consistent. Higher income means slower portfolio growth. Faster portfolio growth means lower income. QQQ and QQQM win on portfolio growth. JEPI wins on income by a massive margin. SCHD balances both better than any single ETF. And no single ETF wins everything. This is exactly why most serious investors do not put everything into one ETF. They build a portfolio where each ETF has a specific role. 2 complete portfolios, built for 2 different investors. Instead of one combined portfolio, here are 2 specifically designed combinations built for 2 completely different investor situations. Portfolio 1, the income portfolio. Build for investors who need meaningful cash flow now or within the next 5 years. 40% JEPI, $40,000, anchors the income. 35% SCHD, $35,000, grows the income over time. 15% VOO, $15,000, maintains steady U.S. market growth. 10% QQQM, $10,000, adds long-term growth potential. Combined metrics: blended dividend yield 5.12%, blended dividend growth 9.1% annually, blended share price appreciation 6.8% annually, What $100,000 looks like in the income portfolio over 10 years. Year 1. Portfolio grows at $112,380. Dividend income, $5,120, or approximately $427 per month. Year 3. Portfolio reaches $142,100. Dividend income, $6,880, or approximately $573 per month. Year 5, portfolio reaches $179,650. Dividend income, $9,240, or approximately $770 per month. Year 7, portfolio reaches $227,120. Dividend income, $12,420, or approximately $1,035 per month. Year 10, portfolio reaches $318,460. Dividend income, $18,640, or approximately $1,553 per month. After 10 years, the income portfolio has grown to $318,460, while generating $1,553 every single month. For an investor who started with $100,000, that is $1,553 per month in passive income without selling a single share. Portfolio 2, the growth portfolio. Built for investors who are 15 or more years from needing income and want maximum long-term wealth accumulation. 35% QQQ, $35,000, primary growth engine. 30% QQQM, $30,000, secondary growth with lower fees. 20% VOO, $20,000, broad U.S. market stability. 15% SCHD, $15,000, dividend income that grows over time. Combined metrics. Blended dividend yield, 1.42%. Blended dividend growth, 7.8% annually. Blended share price appreciation, 15.6% annually. What $100,000 looks like in the growth portfolio over 10 years. Year 1, portfolio grows to $116,440. Dividend income, $1,420, or approximately $118 per month. Year 3, portfolio reaches $157,820. Dividend income, $1,649, or approximately $137 per month. Year 5, portfolio reaches $214,030. Dividend income, $1,916, or approximately $160 per month. Year 7, portfolio reaches dividend income, $2,226, or approximately $186 per month. Year 10, portfolio reaches $450,370. Dividend income, $2,860, or approximately $238 per month. After 10 years, the growth portfolio has reached $450,370, more than 4.5 times the original investment. The income is modest at $238 per month, but the portfolio growth is genuinely spectacular. For an investor with a long time horizon who reinvests those dividends throughout, the growth portfolio compounds into extraordinary long-term wealth. The decision framework. Which one is yours? Here is a simple 3-question framework to identify which ETF belongs in your situation. Question 1. When do you need income from this money? If you need income within 5 years, income portfolio. If you need income in 5 to 15 years, blend of both. If you do not need income for 15 or more years, growth portfolio. Question 2. How much monthly income do you actually need? If you need more than $1,000 per month, income portfolio heavy on JEPI. If you need $500 to $1,000 per month, balanced blend of SCHD and JEPI. If income is secondary to growth, growth portfolio heavy on QQQ and QQQM. Question 3. How much volatility can you tolerate? If market drops of 30 to 40% would make you sell, income portfolio. If you can hold through significant drawdowns, growth portfolio. If you want middle ground, equal blend of both portfolios. Marcus, at 42 with 10 years to retirement, decided on a blend, 60% income portfolio, 40% growth portfolio. Enough income building for the near term, enough growth engine for the long term. But Marcus's situation is not your situation. Your 3 answers to those questions tell you exactly where your $100,000 belongs. Your challenge this week. Write down these 3 things right now. 1. How many years until you need this money to generate income? 2. How much monthly income do you actually need from investments? 3. How much short-term volatility are you genuinely comfortable with? Those 3 answers tell you exactly which ETF or combination belongs in your portfolio. Then post your answers in the comments below. Just the 3 numbers, no judgment, no wrong answers, just real investors figuring out real situations together. If this comparison changed how you think about ETF investing, subscribe to this channel. Every week we break down investment strategies, portfolios, and financial decisions, using real numbers and real data so you can make better choices with your money. Next week, we are going even deeper. We are showing you the exact dividend portfolio strategy that generates $4,000 a month in completely passive income, starting from as little as $20 per day. 3 specific strategies, real projections, step-by-step breakdown. You do not want to miss that one. Subscribe, hit the notification bell, and share this video with someone who is still trying to figure out which ETF is actually right for their situation, because now you both know. See you next week.